Have you ever wondered why an investor might intentionally seek out the financial struggles of a company, viewing its debts not as a burden, but as a valuable opportunity? It seems counterintuitive to buy something for full price, let alone at a discount when it is in trouble. Acquiring a company's debt for less than par, meaning below its face value, is a core strategy in distressed debt investing because it unlocks multiple potential avenues for profit and control. This approach capitalizes on the financial distress of an issuer, allowing the investor to purchase debt at a discount to its ultimate recovery value or to strategically gain influence over the company's future. The primary mechanism enabling this discount is the market's perception of risk and the issuer's impaired financial health. When a company faces bankruptcy or significant financial difficulty, the market price of its outstanding debt instruments, such as bonds or loans, typically falls sharply below their par value. This decline reflects investor concerns about the company's ability to meet its obligations, the potential for default, and the uncertainty surrounding future recovery. Investors are willing to sell their holdings at a loss to avoid further downside or to exit in a liquid position, creating an opportunity for a distressed debt investor to acquire the debt cheaply. Practically, an investor would identify financially stressed companies through credit reports, news, and specialized financial services. After thorough due diligence on the company's assets, liabilities, and legal structure, the investor would then negotiate with existing debt holders to purchase their positions at a discount. The goal might be to accumulate a significant portion of a particular debt class, such as senior secured loans, to influence reorganization proceedings, or even to facilitate a debt for equity swap, converting debt into ownership. Key concept here is the absolute priority rule in bankruptcy. This rule dictates the order in which claims are paid, typically favoring secured creditors first, then unsecured creditors, and finally equity holders. By acquiring debt, especially senior debt, at a steep discount, an investor can position themselves high up in the capital structure, enhancing their potential recovery even in a liquidation scenario, or giving them significant leverage in restructuring negotiations. This strategic positioning often forms the basis of what is known as a distress for control play, where debt holders can ultimately take over the company. Ultimately, acquiring a company's debt for less than par is a sophisticated strategy designed to leverage market inefficiencies and legal frameworks. It allows investors to capitalize on a company's financial distress, either by profiting from the eventual recovery of the debt at a higher value, or by gaining a controlling stake in the company itself, guiding it through restructuring, and ultimately aiming for a significant return on their investment.